30% annual return of 3 blue chip dividend companies. That's what we're going to be discussing today. So what if I told you you could take 3 of the safest, most reliable blue chip companies on earth, invest under 100,000 and generate a massive 30% annual return? You know, most investors think blue chip dividend stocks are boring, that they are stuck scraping a 1 to 3% yield while waiting years for growth, right? But if you know how to build your portfolio at the right time and layer on our wealth triangle cash flow strategy, you can turn a modest portfolio into a legitimate revenue generating machine. And in this video, we're going to show you exactly how to do that. In our previous deep dive videos, we broke down exactly when the best times would possibly be to dollar cost average on these blue chip stocks, right? And those stocks was Microsoft, Home Depot, and UPS. We have a full library of all of our deep dividend deep dives. And if you actually want to take a look at that, just go and take a look at the playlist in YouTube. And today we're going to put them all together. And I'm going to show you the exact blueprint of how a sub 100K portfolio generates over $26,000 a year in sustainable revenue. Yes, you heard me right. $26,000 per year. That is a 30% return on your investment, essentially, at the end of the day, with blue chip stocks, right? So if you're ready, let's get into the math and I'll show you exactly how we did it. If you've watched any of our previous dividend deep dive videos, you know that we are gung-ho on dollar cost averaging based on technical analysis, right? We aren't buying at the all-time highs here or on stock tips that, you know, a friend of ours gave us or anything like that. We are looking at this from a pragmatic perspective and actually looking at the technicals and saying, okay, when is the best time or the most optimum time to actually dollar cost average into shares that we might actually already have or a portfolio that we're actually trying to build. And now let's get into how we structured this under 100K portfolio that actually is on track to bring us a 30% return for the year. First and foremostly, let's jump into Microsoft, right? And for this, we're going to jump into the wealth grid so that I can actually show you the numbers on screen, right? So first and foremostly, let's jump into Microsoft and just take a look at what the annual dividend per share is. The annual dividend per share is currently standing at roughly about $3.56 per share, right? When we did our deep dive video, we were dollar cost averaging at about $375 to $400 on Microsoft at the time. So now let's take a look at Home Depot, which is our second stock. Home Depot's annual dividend share is roughly about $6.93. When we picked this up from a dollar cost average perspective, we had picked it up at about $300. Now let's take a look at UPS. So UPS annual dividend per share is roughly about $6.56. When we picked up UPS, we picked it up for roughly about $94, $95 at the time. Okay, so now that we've got the numbers out of the way, I just want to give you a quick snapshot of what this actually looks like from a visual perspective, right? So we can see exactly how much we actually spent on this portfolio. And then later on, I'm going to show you exactly what the returns was on that. So for that, let me just jump into an Excel presentation quickly. So in this graphic, you can see we bought Microsoft 100 shares for $37,000. Home Depot, we bought 100 shares as well for around about $30,000. And US Postal Services, UPS, we bought 200 shares at $94 per share. And that was roughly $18,800. Our total spend on this was $85,800, right? That's way under $100,000. And the reason why that 100,000K mark is so important is because you still have a little bit of spare cash to deploy if and when the stock actually might pull back and you actually wanted to dollar cost average even more than what you have at the moment. And just by holding these shares, you become part owner of these 3 massive companies. Look, I don't think Microsoft's going anywhere soon, neither is Home Depot, neither is UPS, right? So you can be sure that dividend payment that they are paying you on a quarterly basis is going to stay true and that revenue line is going to stay consistent, right? There's also going to be increase from a stock valuation perspective, right? So the growth that you actually have in the stock, which is actually our third leg of our wealth triangle. And we'll come to that a little bit later on in the video. So now let's jump back into the actual graphic that we saw earlier and take a look at what the expected dividend yield is for each one of these stocks. Okay, so we're back in the graphic and we can see that for Microsoft, we have a dividend payout per share of $3.56, right? That brings your dividend income for the year to $356. Likewise, for Home Depot, we've got a dividend payout per share of $6.93, which gives you a dividend payout for the year of $693. And because we actually bought 200 of UPS, we have a dividend income for UPS at $1,312. And that brings our total net dividend income just for owning these three stocks to roughly about $2,361. Now that's almost a 3%, which is great, right? But you might say to me, Ricardo, yes, I can also just take my money and put it into a high yield savings account and get exactly the same type of return. Yes, you could, but you are missing out on two additional revenue streams, which is what we're going to be diving into right now. So look, $2,361 from a dividend perspective for the year is not bad, right? It covers some of the bills, but we aren't here to just cover the bills. We're here to actually supercharge your portfolio and actually put you in a position to start making real money, right? And the second strategy that we actually employ with regards to the wealth triangle strategy is by selling covered calls. And in this instance, we're going to be selling covered calls on a 2-weekly basis. Now, if this is the first time that you're actually hearing the word covered calls, don't be nervous about it. It is a super simple term to actually understand, and there's so much information that we have on Mindshift Theory and on the Wealth Circle that will explain all of this to you. A covered call is basically you just renting out your shares like you would rent out a rental property, right? You're renting out the shares that you currently own for a premium that somebody's actually going to give you. And that premium, you're going to rent it out on a 2-weekly basis. So basically, you'll rent the shares out, somebody will pay you every 2 weeks, and then you'll do the same thing for the next 2 weeks. Now, there's another term that also might be new to you, which is called delta. Now, delta is one of those things that we actually use to determine where we're actually going to sell a specific strike at to gain that premium, right? And normally, we would always say to people, look, from a safety perspective, look at a delta between 15 and 20. And for this exercise, we're going to use the delta of 20. So what does delta actually mean? For those new to options, a 20 delta means that there's roughly 80% statistical probability that the stock will stay below that specific strike price by expiration, right? And that strike price is the price that we're saying, hey, we'll rent out the shares to you for this price. And if the stock doesn't go above this price, then you pay me this premium, I keep the premium, and you get to rent it again for the following week. That's kind of how it works, right? Super simple. And if we're repeating selling covered calls every 2 weeks, you are doing this exercise 26 times per year, which means there's 26 times that you're actually going to be creating incremental revenue off the stock that you already own, right? So let's look at what that actually means in real revenue terms. For that, I'm going to jump back to the presentation, to the graphic, and just show you what that actually means based on the calculations that we've done. Okay, so looking at the graphic here, you can see that for Microsoft, if we sold 26 covered calls for the year, we'd be looking at generating an additional income of roughly about $4,289. For Home Depot, we're looking at $3,348. And for UPS, we're looking at $2,916. And remember that UPS, we actually bought 200 shares, so we can actually sell 2 contracts. Each contract necessitates you to actually own 100 shares of the underlying equity or underlying stock, right? So let's total this up. 4,000 for Microsoft, 3,300 for Home Depot, 2,000, let's say 3,000 for UPS. You've generated an extra $10,000 of covered calls of stock that you already own, of stock that you've actually rented out 26 times during a period of a year. But that's not all. I want to show you what the stock appreciation actually looks like for this portfolio that we have. And you can see, how much the stock has appreciated and what that actually means to your final end numbers at the end of the day. So today is the 1st of June. So I'm going to jump back into the graphic that I've just showed you. and open up the 2 or 3 columns that you haven't seen yet, which is the current value of the stock, as well as the stock appreciation. Now, anybody watching this video, if you want to go and actually validate this data, be my guest, take a look at what the stock has been today, the 1st of June, and you'll see that these numbers are completely factual, right? Okay, so here's the graphic with the completed data, and you can see the current value of the stock today, the 1st of June, is actually 47,000. I did this presentation yesterday, and it was at 46,000. Today, it is actually at 47,000. Microsoft, 100 shares is going to cost you $46,000. We paid 37 for it. So we've actually made $10,000 on it, right? Home Depot, 100 shares. It's currently trading at 31,700. And UPS is currently trading at 10,600, which we have 200 off, so it's 21,200, right? So let's total all of this up and let's see how the Wealth Triangle strategy has given you a 30% return on investment off the 3 stocks that you actually bought while dollar cost averaging, right? So essentially we made $2,361 just of dividend income for the year. We had a covered call strategy that we executed on a 2 weekly basis, right? That gave us an extra $10,553. And as for the stock appreciation, you know, when you buy quality stocks, it's often going to appreciate over time, right? And for us, we can already see the appreciation that has happened, and we're only halfway through the year at the moment. We've already seen an appreciation on the stocks that we bought at the beginning of Q1 and Q2 of $13,100. And if I actually just rounded this out and we looked forward for a year's period, we'd gain $26,000 off these 3 shares by utilizing the Wealth Triangle strategy. Now, whenever I'm putting together these videos, I always want to be 100% completely transparent with you guys, right? And completely real. And at the moment you might be saying, oh, Ricardo, so what's the catch here, right? Well, there are a couple of things to be aware of, and I just want to be completely transparent about it. Now, look, stock is always going to move up and down, right? And when you're selling a covered call at a specific strike price, you might get to a point where the stock has risen above your actual strike price, which means that you are now obligated to actually sell those shares. But is that such a bad thing? Because you're always selling above what you actually bought the stock for, right? So you will actually be selling that stock if it is called, if you have to, you'll be selling that for a profit, right? But there are other methods that we teach here at MSFT Theory, namely rolling a call. So you're going to roll the call to the following week, or 2 weeks out, or 1 month out, so to speak, to maintain your shares, right? You will just move up the strike price of the contract that you keep on selling. And if you want to know more about that, then come and visit us here at MSFT Theory. Join the Wealth Circle. There's a ton of free information. We've got a completely free option trading course that you can go through, cost you nothing, and you'll get a lot more familiar with these type of concepts, right? So let's just run through the numbers as a quick recapper again. On this investment, we invested $85,800. Our expected dividend income for the year is $2,661. We have made roughly about $10,000 on covered calls, right? Selling covered calls every 2 weeks. And we've had $10,000 appreciation in the stock. Our total projected revenue for this is $26,000 for the year. That's a 30% total return on the money that we actually invested for the year. So if you found this content valuable, please like and subscribe, and share it with a friend that you might feel could gain some value from information like this, right? So if you've missed any of the other individual deep dives that we've done on stocks, and we do one every week, right? Then you can actually go and watch them in this playlist. There's a playlist called Dividend Deep Dives. You can also access this through the Wealth Circle through our group. Just join the group, it's for free, and all of this content is right there for you to actually see, right? If you've liked this, please drop a comment below, share it with a friend that might actually find this content valuable, and like and subscribe so that you don't miss our next Dividend Deep Dive video. Until then, we'll see you in our next video.